Hello, hello, hello. Welcome to our next chapter, that is derivative analysis and valuation. Now, this is your chapter 9 in the AFM in 50 pages notes. So, this chapter comes for approximately 15 marks every attempt, and we will do this chapter very easily. Okay. So, basically, in this chapter, first we will cover your forward contract, then we will cover your futures, and we will cover your options. Okay. Perfect. So let's first understand what is a derivative. So derivative is basically an asset. It is an asset which derives its value from another asset. It is, say for example, you are betting. Okay. So say for example, you are betting at a horse race. Now this bet, the value of this bet is derived from the value of the from the other asset, that is your stock, how your horse performs. Perfect. So similarly, derivatives is something which is based on stocks. So let's see in this case. So we have our forward contract and we have your futures contract. So what is a forward contract? A forward contract is an agreement between a buyer and a seller, obligating the seller. When you say obligating the seller, that means they have to do this. Obligating the seller to deliver a specified asset of specified quantity, and the buyer is obligated to buy at pre-negotiated prices. So say for example, you and I enter into a transaction and you tell me, Dheer, you have to sell me 10 kgs of rice at 20 rupees per kilo 3 months later. So now both of us are obligated in this transaction. A futures contract is also similar, just that it is very standardized. So futures contract is similar to a forward contract exchange, except that it is settled only via margin money. That means actual delivery does not take place. They are either settled by cash or by physical delivery. So if it is settled by margin money, then in such a case actual delivery will not take place. Otherwise, actual delivery will take place. It is traded via exchange and these are standardized. Okay, so you and I cannot enter into contract that no, I wanted this price. Whatever price is set in the market, that is what has to be followed. Perfect. Now let's understand what is the meaning of basis. So a lot of times you would have heard ki when we say basis point. So basis is nothing but the difference between spot price and future price. If when we say spot price means price today. Okay, so we are saying spot price minus future price. So say for example, you are able to purchase a coconut today at 60 rupees, and in the future you are able to purchase this coconut at 65 rupees. In this case, your basis is 5. Basically, you find the difference. So therefore, they say that if it is positive, if the difference is positive, that means your prices today are more than the prices in the future. Then in such a case, your market is in backwardation or it is an inverted market. That is, price of the good falls in the future. Second is, if this is negative, the basis point is negative, that means market is in contango. Anything that is priced today will be priced higher in the future. Okay. And now this converges. The difference between spot price and future price keeps on reducing as we approach the expiry of the contract. So this contract is for a specified limit of time. So as you come closer to this expiry date, this difference comes closer to zero because your spot and future are not that far away from each other. Perfect. Nice. Now we'll see the formula for future price as to how do you usually calculate a future price. So say for example, you have a cow. Now you want to determine that this cow's price 1 year later will be what? Okay, so you have to see, boss, what is the price of my cow today? So that is your spot price. Now you see, okay, from today till 1 year later, do I have to spend anything on this cow? That is true. You have to feed the cow, you have to take care of medicines, you have to feed it water, etc. So therefore, all of this becomes part of your carrying cost. So whatever cost you have to bear just to hold that asset is your carrying cost. So therefore, this carrying cost will be added. Okay, now you have to see, does this asset also give me some benefits? By holding it for a period of 1 year, what benefits do I receive? I will get milk from this cow. I might also get future baby cows. Correct? So all of this is your return. So therefore, this will be subtracted because these are your benefits. So therefore, returns in stock would be your dividends. So this is the theoretical minimum price. So your future price is your spot price today plus your carrying cost minus your returns or your dividend. Clear? Perfect. Now let's follow a question on this. It's a little complicated than the formula that we just saw. So your spot price today of a stock is rupees 220. Perfect. 3 months future price is 230. That means after 3 months the price increases by 10 rupees and comes to 230 rupees. Okay. Borrowing rate is 15% per annum and the dividend receivable before expiry is equal to rupees 2.5. That means during these 3 months, you will also get a return of dividend of 2.5 rupees. Perfect. So now we will calculate what should be the future price. So the future price, ideally, the future price, say for example, I borrow today. Okay, so the future price should be 220 rupees. Correct? This 220 rupees so is cost today. This is your spot price. Next is your carrying cost. That is to buy at 220 rupees today, you will have to borrow. So you will have to borrow 220 rupees. You will have to borrow 220 rupees at 15% for 3 months divided by 12. Correct? So this will be part of your interest. This is what how much ever interest you are paying. And you subtract 2.5 rupees. You subtract 2.5 rupees because that is your dividend, that is the return you are getting. So we've calculated that the actual future price should be 225.75 and not 230. That means the price that we have calculated of 225.75 is less than 230, which means arbitrage opportunity exists. So first we have to prove that arbitrage opportunity exists by doing this calculation. Clear? Perfect. Now you will decide as to what to do. So an arbitrator, and arbitrator, if you see, it costs him only 225.75 rupees to borrow and buy the stock. So arbitrator will buy the stock at 220 rupees by borrowing 15% for 3 months. Correct? And this future price, this 230 rupees is what it is overpriced, so we will sell it. So therefore, we sell the future. On expiry, the futures contract will be settled by delivering the stock he bought. So this is settled by actual delivery. Correct? So profit is the sale proceeds from futures. It is the sale proceeds from futures plus dividend minus principal repayment minus interest. Sale proceeds from futures. How much did you get from selling the futures? You get 230 rupees. Is that clear? Okay, how much dividend are you receiving in this 3 months? You are receiving a dividend of 2.5 rupees. So this 2.5 gets added, right? Now what goes out is your 220 rupees. That is the amount you had borrowed. This principal. So 220 rupees and 8.25 is your interest amount. 8.25 is your interest amount, which gives you a profit of 4.25 rupees. This is what we call profit, which is riskless. Whenever there is a question of arbitrage, it means riskless profit. What did we do? We borrowed, we held the stock, we sold the futures. 3 months later, we settle this future by delivering a stock. Clear? Perfect. Coming to your next part, that is your compounding. So in compounding, we have two types of compounding. First is your periodic compounding, and second is your continuous compounding. Now, what is the difference in periodic compounding? It compounds maybe yearly, every 6 months, every 4 months, every 3 months. It compounds basically. Interest also becomes part of your principal and interest gets added on to it. So that is your periodic compounding. What is continuous compounding? Continuous compounding is when it compounds every second, every nanosecond, every millisecond it compounds. It keeps on increasing. So therefore, your amount in continuous compounding is much higher than your amount in periodic compounding. This is your understanding one. Now let's see the formula. So if you do annual compounding, we say amount is equal to principal into 1 plus r raised to the power t. P is your principal, 1 plus r is your rate, and t is your time period in years. So this is your annual compounding. What happens if we compounded n times? Say for example, we compounded quarterly. When we say compounded quarterly, that means 4 quarters in a year. Correct? 4 quarters in a It's not your drinking water. Okay, so 4 compounds in a year. So we basically it gets compounded 4 times. So in such a case, your amount is equal to your principal into 1 plus R by N. R by N is R by 4. If your rate of interest is 12%, that means 12 by 4 will be 3%. Okay, and then you raise to the power NT. That is your number of times that is being compounded into your time period. Next is your continuous compounding. In continuous compounding, you have to make sure that if there is any income receivable, how to take care of that. So if your income is receivable in terms of rupees, in terms of amount, your income could either be receivable in terms of amount or it could be receivable in terms of percentage yield. So if it is receivable in terms of amount, you use this formula, that is amount is equal to P minus I. P minus I is your principal minus your income receivable. Perfect. So you basically you reduce your principal. So it is P minus I into e to the power RT. E to the power RT. Is that clear? Next is when income is accrued in terms of percentage, you do the same formula. A is equal to P, but over here what happens is PE raised to the power R minus Y. So your Y is your yield percentage. So you do R minus Y into T. Correct? Is that clear? So over here, what did we did? We subtracted it from the principal, and in here, what we are doing, we are reducing our interest rate because your yield is in percentage. Let's solve a quick example on this. Whatever is in part of orange is part of your question. Whatever is in black is part of your answer. So there is a 4-month forward contract on 500 shares. Okay, at 75 each. Perfect. So there are 500 shares, and each share is 75 rupees. Dividend at the rate of rupees 2.5 per share is expected to be received in a period of 3 months. So dividend 2.5, okay, expected to be received in 3 months. Your CCRRI is your continuous compounding rate. Your continuous compounding rate of interest is 10% per annum. Okay, it is 10% per annum. What should be the value of the forward contract? Let's see how do we calculate this. So first, what do you have to do? The dividend that you are about to receive in 3 months, you will have to bring that what is the value of the dividend today. Correct? So you will have to bring it from 3 months. This is where you are standing today. This is okay. This is day zero. This is 3 months, and this end is 4 months. The dividend you are getting at this point. So therefore, what do we have to do? What should be the value of the forward contract? We want to find the value of forward contract on day zero. So therefore, this dividend will also be have to be brought 3 months back. Is that clear? So we are calculating present value of dividend proceeds which are to be received after 3 months. How much dividend are you going to receive? You are going to receive 500 rupees. You're going to receive five. You're going to receive 500 shares into 2.5 rupees per share. So this is your amount, total amount. Now to bring it to your present value, divided by E, correct? So that is E raised to the power 3 by 12 because it is for 3 months that you are bringing it back. And what is your rate? What is your rate? Your rate is 10%. So E to the power RT is what you are doing. So you multiply E to the power RT and you get that my dividends present value is 1219 rupees. Clear? Now we have to calculate what is the value of your forward contract. So your forward contract is 500 into 75 rupees. That is the value today. Value of cow today, correct? Is that correct or not? Hmm? So this is your basically your principal, that is 500 into 75, which is what we did here. Okay, we are going to be using this formula. So we did principal minus your dividend. Correct? That is your income. So that is 1219.13 you subtracted into 4 to the power 12. Now you have to calculate this value 4 months later. Correct? So therefore we do 4 by 12 again into your rate of interest, that is your 10%. So you get that the value should be 37,498. This is what the actual value should be. Correct? Make sense? Perfect. Next is your index futures. What are index futures? Index is basically, say for example, Sensex is your index, Nifty is your index. Correct. So basically what happens in this case, they are broken into contracts. Okay. So and each contract has 50 units of the index. Perfect. So one contract has 50 units of Nifty 50 into the value of Nifty 50. That is your value of the contract. Both buyer and seller have to deposit margin money. Sir, what is this margin money? This margin money is used to cover any fluctuations in the market. Margin has to be replenished if it falls below the minimum margin requirement. Expiry date is last Thursday of the relevant month. Investor can square off the position either at any time, or they can wait till the expiry, that is your Thursday. Let's see how we solve this question. Right. So investor shorts, when an investor shorts October Bank Nifty, that means the investor will gain if the price is fall. That means the investor will gain if the price of that commodity falls. So investor shorts October Bank Nifty futures at 25,000. 1 month later squares off at 24,000. That means the Nifty had fallen. Correct. So the Nifty falls from 25,000 to 24,000 and he squares off. That means he closes this contract. He gains 1,000 because what did I tell you? He gains when there is a fall in price. So in this case, one contract is 10 units of Bank Nifty. In this, he did Bank Nifty. So therefore, it's not 50. The question has given us as 10 units of Bank Nifty. Margin requirement is 10%. Okay. Let's study what is our initial outflow. Your initial outflow would be what? Your margin. That is 25,000. That is the price that was there when you entered into the contract. One contract has how many Nifty futures? It has 10. So 25,000 into 10 and your margin requirement is 20%. So therefore, your initial outflow will be 50,000. Okay. Next is your cash inflow. Cash inflow upon squaring is what you get. You profit and you get your margin. So you made a profit of 1,000 rupees. That is 25,000 minus 24,000. You multiply it by 10 because there were 10 futures in this contract and you again add your 50,000 margin that you had submitted. So you get 60,000 return. So basically you invested 50,000 and you got 60,000 in 1 month. So that is basically what, if you see from a percentage point of view, you get 20% return in 1 month, which means 2,400% return in 12 months. So therefore, futures options give you crazy return percentages, but they also give you crazy loss percentages. Now imagine if in this case, instead of the market going down, if the market had gone up, this guy would have settled in loss and there would have been a huge loss. Okay, perfect. Now let's study the next part, that is your hedging. What does hedging exactly mean? Hedging says ki boss, I do not want to take risk. I am a businessman. I do not control prices. I don't want price fluctuations to affect me. So in hedging, what do? You take position in one market to offset and balance risk adopted by assuming position in opposing investment. I'll give you an example. Say for example, I am an exporter. Okay. I'm an exporter. If I'm an exporter, that means I sell goods and I receive payment in foreign currency. So I am about to receive $100 for the sale that I just made 3 months later. Now I know that I am okay with $100 as per today's prices, but I don't know if I'm okay with $100 as per futures prices. What if the dollar price goes down? So therefore, I don't want to take this risk. What do? I am about to receive dollars, correct? I am about to receive dollars in my actual world. So therefore, I will do an opposite transaction where in the future I will have to give dollars. So therefore, my price will be fixed. I will have to give dollars at a fixed price. So therefore, my price will be fixed. Okay, let's see an example in this. So investor had bought 100 shares of Tata Steel at 300 rupees. Okay, so the investor bought. That means what is his risk? Risk is when the Share price, tell me what happens when the risk is share price. If the share price goes down, that is his risk. So therefore, he will enter into a similar contract where if the share price goes down, he gains. He will enter into a opposite contract, not a similar contract. He will enter into an opposite contract where if the share price falls, he will gain. Got it? That means he will short the stock. So therefore, investor had bought 100 shares of Tata Steel at 300. Now the stock is at 350. Ooh, 50 rupees profit he is already sitting on. He is concerned that the profit might get wiped out, but wants to keep the stock till September because of an upcoming dividend. He wants to keep the stock because this stock is going to pay dividend. So what does he do? He sells the 350 rupees September stock future. I told you, because he gains, he has the stock in his physical year, therefore he will sell the stock. So he investor sells future contract. That means if the price goes down, he gains in the future, even though he will lose in his actual stock. On expiry, the investor sells the stock at market price and buys back the future contract. What does he do? He sells the stock at the market price and buys back the future contract. Understood what is happening? Yes. So let's see. Your cost of scrip, that is the cost of stock, is 300 rupees into 10. Let's say we take two cases. That means the September closing price is either 300 rupees or the September closing price is 400 rupees. That means we were at 350. So if the price falls down to 300, he will lose money in the stock, and if the price goes till 400, he will gain money. But because he has hedged, what we want to show, there will be no profit, there will be no loss. So cost of script is 300 into 10, that is 30,000 in both of these cases. Margin payment that he will have to pay is 20% in both of these cases. So both of these cases is 7,000, 7,000. Therefore, total initial outflow is your 37,000 in both cases. Right? Now let's see what happens when you sell this stock in the stock market. So when you sell the stock in the cash market in September, what is the closing price in case one? That is 300 rupees. So 300 rupees into 100 stocks, you get 30,000. And in the second case, when the price is 400, you got 400 rupees into 100 shares, which is 40,000 rupees. Ooh, 10,000 rupees, we are already better, but this is only stock. Now we will see futures. What is the margin refund on the futures contract? This initial margin that you had paid of 7,000 rupees, you will get back also. So this 7,000 rupees you get back. Okay. So this is done. This is done. Next is your gain on futures contract. Your gain on futures contract. So therefore, what happens in such a case? You had sold your futures contract at 350 rupees. You will gain if the future contract falls. Correct? In this case, in case one, the price came down to 300, so you gain 50 rupees. You gain 50 rupees for future contract and you did this for 100 futures, so therefore you gained 5,000 rupees over here. While in the other case, you lost 50 rupees here because the price increased and you got a loss of 5,000 rupees. So therefore, total inflow on maturity when you calculate is same for both of these, that is 42,000, and your net payoff is 5,000. Did you understand what happened? Because of this hedging position that we took, whatever whatever the price is at the end, we don't care because we have hedged. We do not have any risk because of market fluctuations. Even before entering, even before September end, we already knew that we are going to get a net payoff of 5,000 rupees. Clear? This 5,000, I'll tell you how it's calculated. This 5,000 calculated because of this profit that you bought at 300 rupees and you were holding it at 350 rupees when you took the hedging position. So this 50 rupees is what you have earned on 100 shares. That is what your net payoff of 5,000 rupees is. This is your 50 shares into 100 rupees. Clear? I hope hedging is clear. Next, we will come to options. Till now, what we were doing, whatever the price, you have to honor the contract. In options, it is a little different. As the name suggests, it says it is an option. So what do we mean? It is a privilege. It is a privilege sold by one party to another that gives the buyer the right, not an obligation to buy or sell an underlying stock, forex commodity at an agreed price with a certain time period. What is the price of an option? It is called premium. Okay, let's understand what is an option. An option is, say for example, you and I enter into an option contract where you have to have a you want 300 oranges. You want 300 oranges 3 months later. Okay, and you say, कि, Dheer, I want an option that current market price today is 50 rupees per orange. Here I want an option that in the future I have this option to purchase it at 50 rupees from you. I don't have an obligation, I have an option. So you tell me that here I want an option to buy oranges at 50 rupees 3 months later. But I tell you, ki, boss, if on that time the market price is 55 rupees, then in such a case, what will you do? You will buy from me at 50 rupees, where in fact I could have sold it in the market for 55. Correct? So it is a loss for me of 5 rupees. While if the market price on that day was 40 rupees, then would you come to me, ki, Dheer, oh, let me buy it from you at 50 rupees? No. You will go in the market and you will buy it at 40 rupees. Correct? So therefore, when does Dheer gain in this transaction? So therefore, Dheer gets what is called an premium. So to enter into this contract, I will tell you, okay, I will give you this option. I will give you an option, not an obligation. I will give an option that you can purchase oranges from me at 50 rupees. But for every one orange today, I want 3 rupees as my fees to enter into this contract. So basically, on 300 rupees, on 300 oranges, I will get 3 rupees per orange. I will get 900 rupees. My profit is fixed. My profit is fixed that 900 rupees is the maximum that I can get. If on that day the price is lower, if on that day the price is lower, what did you have? You had option to buy. You had option to buy oranges. Option to buy at 50 rupees. If on that day the price is 30 rupees, you will not come to me and you will buy from the market at 30 rupees per kilo. And I will sit with my 900 rupees that I have, that is 300 oranges into 3 rupees. What is the other thing? What if the market price is 60 rupees? In such a case, you will come to me and you will buy. Basically, you gained, you saved rupees 10 rupees. Otherwise, if from the market you would be purchasing it for 60 rupees. You can purchase it from me by 50 rupees. You are saving 10 rupees per orange by paying a premium of rupees 3 only for me to enter into this contract. So therefore, I will have a loss of 7 per orange and you will have a gain of 10 per orange minus the 3 rupees premium that you paid, which is 7 per orange. Is this clear? Is options clear? Options is an option. It is not an obligation. Okay. So whenever one party has the option, that party has to pay premium to the other party. This party can have option of both. They can have an option of buying or they can also have option of selling. Okay. The other party receives premium. For buyer, the risk is limited to premium, but profit potential is unlimited. The buyer, that is you in such a case, you only had to pay premium of 3 rupees per orange, but the profit is unlimited. Say, for example, the orange price shot up to 200 rupees per orange. You are saving 150 rupees per orange. Do you get it? You are saving 150 rupees per orange in exchange of only paying rupees 3. So your profit potential is unlimited. Your risk is only limited to your premium. At the most, what you will lose is only your premium. For the seller of the option, that is me in this case, risk potential is unlimited. I can have unlimited loss and my profit is only limited to premium. Clear? Perfect. Next is your types of options based on when they can be exercised. So your option either can be exercised at expiry or it can be exercised during any period of this time. So if there is a date of purchase and there is a expiry date, it is an American option that can be exercised at any point of time between this date, but a European option can only be exercised at the end. This can be asked in your MCQ, so make sure you know this. Americans can do it anytime. Europeans can only do it in the end. Perfect. Now let's see our valuation technique. For valuation techniques, we have three valuation techniques, out of which first is your binomial model. What does binomial model tell you? Binomial model tells you it breaks down time into expiration into potentially a very large number of intervals of steps. So it breaks such a huge time period into a lot of steps. At each step, the price can move up or down by specific factors. Value is calculated at each step using probability. Okay, so we have the formula that what is the probability of the stock price going up. So we have this formula that is P is equal to R minus D upon U minus D. What do we mean by R? By R we mean 1 by 1 plus risk-free rate. What do we mean by D? D is the down potential. So D is the down potential upon your current price. So it is R minus D upon U minus D. R is your 1 plus risk-free rate. D is your down potential. U is your up potential. That is up potential upon current price. So all of this is in terms of percentage. So this is your probability. Next is your composition of a risk-less hedge portfolio. That means there is no risk in this portfolio. What do you do? So therefore, you have four terms, that is U, CD, SU, and SD. This CD, SD should also, this D should be small. Okay, so we have basically four things. So CU is payoff from call option if price of stock goes up. Okay, so what is the payoff that you will get if the price of stock goes up? C, C is the payoff if price of stock goes down. SU is upward price of stock and SD is downward price of stock. So your C is your payoff from your option and S is your uh, price when it is up or down of your stock. Let's solve a question on this so it will become much clearer. Perfect. So this is your example. Everything part in green is part of your question. Everything in black is part of your answer. So your current share price. Your current share price is 30 rupees and this has been broken down into two time periods of 6 months each. So we think that after 6 months, this price can either increase from 30 to 33 or it can fall from 30 to 37. Similarly, once if it has reached 33, we think after 1 year it will reach 36.30 or it will come down to 29.70. And from 27, it will either come up to 29.70 or it will go down to 24.30. This is what the question has told us. Okay. Calculate the current fair value of a regular call option. You have to calculate the call option price today. If the exercise price is rupees 28, 28 is your exercise price, your risk-free rate is 5% per annum. Also indicate composition of riskless hedge portfolio at the valuation date. Okay, so both the formulas will come. So first let's calculate it. Let's calculate that formula where we do U minus D. First, we'll do that formula where we calculated R minus D upon U minus D. Okay, so for this we will have to calculate what is my R, what is my D and what is my U. R is very easy to calculate it. It is 1 plus your risk-free rate of interest. Do not forget our time periods are 6 months. So therefore you will have to do 6 by 12 or 1 by 2 over here, which comes to 1.0247 is your R. Next is your U, that is your upper potential of the stock. What is the upper potential? It will go from 30 to 33, or it will go from 36, or it will go to 36.30 from 33, correct? So therefore you do 33 by 30 or you do 36.30 upon 33. In both of these cases, your upward potential is your 1.1, right? Basically, it increases by 10%. Sir, what if both of these percentages came different? That will not happen. Institute will give you the same percentage in both of these. We will calculate D, that is your downward potential. So downward potential, it can go from 30 to 27. So therefore 27 by 30, or it can go down from 27 to 24.30. So therefore in both of these cases, it comes to 0.90. That means stock can fall by 10%. So now we've calculated U, we've calculated D, and we've calculated R. Tell me, can we calculate P? That is probability of the stock going up. We can calculate this. So therefore we have all our value, that is R minus D upon u minus d, which gives us a probability of 0.6235. Now, what does this mean? That means the probability that the stock price goes up is 62.35 percentage. So therefore, what is the probability that the stock price goes down? Nothing, simple, 1 minus 0.6235 and you get as 0.3765. 0.3765 is probability that the stock goes down. So now let's see what is the payoff distribution at each level. So therefore, we will we will start from her right hand side. What is your exercise price? Your exercise price is rupees 28. So therefore, say if you see, if the price goes up to 36.30, if the price goes up to 36.30 and you exercise at 28, so therefore you will get a payoff of 8.30. That is your 36.30 minus 28. Similarly, you will get a payoff at all of these. In the last case, you will get a payoff. Remember not to make it negative. This is option. When the market price is 24.30 and you have an exercise, you have an option to buy it at 28. Tell me, will you buy it at 28? Answer is no. Correct? Because when the market price is only 24.30, you will not buy at 28. So therefore, in this case, it is 0. Now, similarly, you do this for now, you come one step before. So, what do we do? That is, in step 2 over here, say for example, we are calculating for this method at 27. The exercise price is what? Exercise price is 28. Now, what is the probability? What is the probability that you gain 1.70 rupees? So, therefore, you at when you are standing here, you can either gain 1.70 rupees or you can gain 0 rupees. Correct? So probability of gaining 1.70 is when the stock goes up. So therefore, this is probability of stock going up, and this is the profit that you get on when the stock goes up. 1.70. What is the probability that you do not get anything? That is your the one that we calculated, 0.3765. This is probability of going down, and this is the payoff, and you bring it to present value, that is you divide it by 1.025, so you get 1.03. Similarly, you do this for 5.68 as well. Same, 8.30 into 0.6235 plus 1.70 into 0.3765 divided by 1.025, you will get 5.68. Okay, and then when you do similar, when you do similarly for this, for both of these numbers, you will get 3.84. So therefore, this is the price. This is the value of your call option. Now, your next question is, what is the riskless hedge portfolio? What is the riskless hedge portfolio? So payoff, if the share is 33, okay, so we are doing these numbers. So if the share is 33, you get a payoff of 5 rupees, that is 28 and 33. If the share is 27, you get a payoff of 0. So therefore, if you remember, we did the formula up, correct? Cu minus CD upon SU minus SD. This is the price if the share price goes up 33 and this is 27. So therefore, what we get is we get a ratio of 5 by 6. So this means that 5 by 6 shares should be held for writing one call option. Understood? So this 5 by 6 means that these many shares should be held to write one call option. In such a case, you will get a riskless hedge portfolio. That means whatever you gain because of your shares, you will lose because of your option, or vice versa. Clear? Perfect. Now let's go to our second method, that is your risk neutral method. So in risk neutral method, what happens? They say that your current price is 50 rupees. In 1 year, it is expected to go up to 60 or go down to 40. So after 1 year, it will either go up to 60 or it will come down to 40. Risk-free rate is 5%. So therefore, what do they do in such a case? So they're like, boss, our expected, so our current price is 50 rupees. Probability that it goes up is P. Let's say that the probability that the price will increase is P. So 60 into my probability plus 40 into 1 minus probability divided by your risk-free rate, correct, is equal to 50. They're saying, so basically they're saying that the probability that the stock goes up is nothing but 62.5%. Okay. And what is the what is my payoff at each? If it goes up to 60, my payoff will be 10 rupees. If it goes down to 40, my payoff will be 0 rupees. We multiply it by a probability divided by the risk-free rate, and we get our amount as 5.95, which is the value of option as per the risk neutral method. Okay, so payout would be 10 if price is 60, would be 0 if price is 40. I hope this is clear. Very, very easy risk neutral method. Okay, so first you have to calculate what is the probability of the stock going up. Then you put this probability into what is the payoff that you will receive, and you find the value of option. Your next is your Black-Scholes model, which is a little complicated formula, and I would suggest that you learn this. Okay, so they say that your call option price is your SND1 minus XE raised to the power minus RT into ND2. And they have told us how to calculate D1 and D2. Okay, your S is your current stock price. What your ND1 and ND2 gives are nothing but probability. So your stock price into probability minus X is nothing but your exercise price. Where is X? X is your strike price. Okay. E raised to the power minus RT is because of continuous compounding that we are bringing into present value. So therefore, this strike price EX into E to the power minus RT is strike price at today's present value. Okay, because your S is also today's price. So we multiply both of these by probabilities. Your ND1 and ND2 both calculate probability. So therefore, now let's see if the formula makes a little more sense. It is S, which is my stock price today, into ND1 minus X, that is my exercise price at maybe 3 months later. So I bring it to present value. So I do into E raised to the power minus RT and I multiply it by probability. Here, now let's say how do we calculate D1? D1 is equal to log natural S by X plus R plus variance upon 2 into T upon standard deviation into root T, and D2 is nothing but D1 minus standard deviation into root T. This formula D1 and D2, I would suggest you learn both of these formulas. Okay, and then there's another formula, put call parity. That means you can find the value of a put if you know the value. uh, you can find value of put if you know the current price of the share, the value of the call, and the present value of the exercise price. So you will be able to find value of put. So basically value of put plus current price of share is equal to your value of call plus your present value of exercise price. Okay, let's study an example on this. Shares are currently priced at 415 rupees. This is your S. Call options exercisable in 3 months. This is your T. At 400 rupees, this 400 rupees becomes your exercise price, that is your X. Risk-free rate is 5%. This becomes your R. Your standard deviation is 22%. Okay, so this is standard deviation as they've given you. Is the option worth buying at rupees 25? This is your first part of the question. Second is, what would be the worth of put option at current price of 415 rupees? That means first they've asked you the value of call and then they've asked you what would be the value of put. So therefore you would use this formula, that is your put call parity formula. And third is, if current price is 408 and dividend of 10 rupees is expected in 2 months time, calculate the value of call option. So they've also included dividend in this method, in this option. Okay. So then they've given you some values, that log natural value. They've given you different values of each log and E so that it helps you calculate. Let's see how we calculate this. Perfect. So first let's calculate our D1s and D2. So D1 and D2 we know is uh, we know the formula. So it is log natural 415 by 400 plus 0.05, that is your R, plus your standard deviation, that is 0.22 whole squared by 2, and you multiply this by 0.25, that is your time, because it is 3 months, so it is basically 1/4, divided by 0.22 into raised to the power into square root of 0.25. After doing all of this, which you get, D1 is equal to 0.50237, and because of which D2 comes to 0.39327. Okay. So you have your ND1. ND1 is basically N 0.503. Oh, what a straight line. Yes. So your ND1 is N into 0.50327 and your ND2 is 0.39327. You have to find out what is the value of this. So this is done via the Z table. So Z table is used when you have to find the probability. So you will basically find the value of 0.50327. Let's see how do we calculate this value. Okay, so we want to calculate the value of 0.50327. That means this lies between 0.50 and 0.51. Correct? So you have to extrapolate the value. So therefore, when you see our Z lies. So therefore, in this case, the Z is negative. So in more detail, if you want to understand, you can watch another video, but otherwise in this case your 0.5, you have Z at 0.50, you have one value, and Z at 0.51 you have another value. Okay, so you extrapolate it and you find what is the value at 0.50327 and you subtract it from 1 because this is a left side table. So you get the probability as 0.6928. Okay, so this is the actual probability, and you do the same for ND2 and you get a probability of 0.6529. So the theoretical call option price is 415, that is your price today, into ND1, that is 0.6928, minus you do 400 into e to the power, then e to the power rate and time into 0.6529, that is your probability. So therefore you get 29.60 as your value of call. So since market price is 25 and as per you the price should be 29.60, that means it is underpriced. It is undervalued and therefore you should buy this call option. Next is your value of put option using the put call parity formula. So you have 415 plus 29.60. Yes. So you have value of put plus 415 rupees, that is your stock option price of stock today, which is equal to value of call option, that is 29.60 plus 400 divided by 1.0125, because you have to bring it to your present value. So you get value of put as 9.66. And third is, since the dividend will be announced in 2 months, the current share price must be adjusted by the present value of the dividend. So therefore, you get 10. The dividend that you are receiving is 10. So you bring it to present value, which comes to 9.917. Adjusted share price is 408 minus 9.97. So you get 398.083. And now you solve this entire question with this new value, that is 398.083. You will get the value of option as 18.98. I would want that you pause the question, solve this, and then move forward. Perfect. I have also given you an explanation of how to use the Z table here. Coming to our last part of this chapter, that is options in the real world, that is your real options. So options, but for investing or disinvesting in a project at a future date. Period will usually start from the end of first year. Let's see what do we mean exactly by this. So types of real options. Is first is your growth option. What is growth option? It is very similar to European call options. So projects which have a negative or an insignificant NPV, but the manager would be interested in accepting the project as it may enable to company as it may enable the company to find profitability and add value in the future. Example, investment in R&D. So today it is a negative, but in the future it could be positive. Heavy expenditure on advertisement, acquiring, making rights, etc. Let's study an example for this case. Yeah. ABC Limited is a pharmaceutical company with patent of a drug called Adrex. Period of patent is 15 years, after which any company can produce the drug as well. It is estimated that the company will require $12.5 million for development and marketing of the drug. Okay. Expected present value from sale of drug during 15 years is 16.7 million. So 16.7 million is your inflow and 12.5 million is your outflow. But this is with a variance of 26.8%. That means standard deviation whole square they've given you as 26.8%. Current yield on treasury bond of similar duration is 7.8%. This is what they've given you as RF. Determine the value of patent and they've given you log natural values and your e raised to the power values. So now you have to understand that how is this an options? This seems like just any other question, right? So the patent gives the company the right but not an obligation to invest the money. The 12.5 million that is had to invest, it is an option for the company, right? It is not an obligation. So this 12.5 million is an option to produce the drug and earn revenues. Correct? So now using Black-Scholes method, let's see what is your S, that is your current today. So the underlying asset price, that is the value if the drug is developed, that is the present value of cash that you will get. In this case, it is 16.7 million. So this becomes your S. Correct? Next is your exercise price. That is the cost of developing the drug. How much you will have to pay. Correct? So that is in this case 12.5 million. So that becomes your X. That is your exercise price. Standard deviation whole square or variance they've given you as 0.268. Correct? Your R they've given you as 0.078. One new thing in this comes your cost of delay. Because you only have 15 years of patent, each year of delay will have some cost to it, correct? So expected cost of delays is 0.0667, that is 1 divided by 15, and your time is equal to 15 years. So again, we will calculate your D1 and D2 using the same formulas. What you have to be aware is this part, cost of delay is new, that will be subtracted here. So therefore, your D1 comes to 1.2315, where n 1.2315 comes to 0.8910. Similarly, you calculate D2 and you get as 0.2196. Now the value of patent is equal to 16.7. That is the output that you are going to receive. That is your S into e raised to the power. You will multiply it with D because every year that you delay, you will have some cost. So you multiply e raised to the power this. So therefore, I put this in new also into 0.8910. That is your probability minus you get 12.5 and everything. So you get as 4.619 million. So we have given effect for cost of delay because unlike a financial option, a real option involves loss of value. Over time, if the owner does nothing, there is a cost of doing nothing as well. Every year you wait, the effective life of the drug reduces because the patent is only for 15 years. Okay. If you want, pause this and solve this and we'll move forward. Okay, next is your abandonment option, just like your X. So abandonment option is option to abandon a project can be exercised if value derived from the project's asset is more than the present value of continuing the project for one more period. Let's say an example. So we have Haggu Limited. Haggu Limited is considering building a new plant to produce pesticides. Present value of proposal is 100 crores without abandonment option. In case of favorable market conditions, present value shall increase by 30%, and in case of unfavorable conditions, present value will reduce by 40%. The project can be disposed of for 80 crores, risk-free rate is 8%. What is the value of abandonment option? So in year 0, your project is worth 100 crores, correct? This is your present value, 100 crores. Year 1, this can either go up by 30% or it can go down by 40%. Correct? In both of these cases, when will you exercise your right to get rid of this project, to abandon the project at 80 crores. If it is already at 130 crore, will you abandon? Answer is no. So therefore, this payoff is 0 rupees. But if the price, if the present value comes to 60 rupees, then you will abandon it for 80 crores, correct? Is that right or not? So you will get a payoff of 20. Now again, we are using the risk neutral method, that is 100 is today. There is a probability that it will go 130 and there is a probability that it will go to 60 divided by your 1.08, that is your RS. On solving, we get that 0.686 is probability of a favorable market, that is probability of it going up is 68.6%. So we will find the value of option. How do? We do 0, that is this payoff, into probability of it going up, that is 0.686, plus 20 into probability of it going down divided by 1.08. So you get value of option as 5.81 crore. So this option that you have, that you can dispose it for 80 crores, is worth 5.81 crore rupees. Is that clear? You see what we did? We included risk neutral method in this as well to calculate probability, because it could go up or it could go down. And now coming to your last part, Pinky promise, last part is your timing option. Sometimes you may want to wait and decide later due to better information or ideas later. Example option, where to invest. Correct. So therefore, this is a timing option. You have an option to choose 1 year later, to choose 2 years later. You don't have to take the decision today. So MIS Limited is considering installation of solar panels for staff quarters. Cost of panels is 2.5 crore rupees. It shall lead to a saving of 21 lakh per annum forever. Beautiful. After 1 year, due to change in government, rate may change, leading to an annual saving of either 12 lakh or 35 lakh. So currently it will give you a saving of 21 lakh, which could either become 12 lakh or it could become 35 lakh. Weighted average cost of capital is 10%, risk-free rate is 8%. Whether you should accept the project or wait after 1 year and see. Let's see what to do in this case. So as per your current, your annual saving is how much? As per your current, your annual saving is of 21 lakhs. So 21 lakhs and your present value of saving is 21 lakh divided by 0.10. Remember, you have to divide it by your back. So it comes to 2.1 crores. If after 1 year the price goes to 35 crores, if the savings goes up to 35 lakhs or the savings go to 12 lakhs, in this case you will have a present value of savings of 3.5 crores or 1.2 crores, but my cost is 2.5 crores. Tell me, is that right or not? So I have a benefit. I have a benefit out of this project only if my actual savings turn out to be 35 lakhs. So therefore, my payoff in this case will be 0.4 crore negative. Payoff in this case will be 1.3 crore negative, and payoff in this case will be 1 crore positive. Correct? So therefore, current is 2.5 crore as my cost of panels investment. I can either This can either go to 3.5 crores or it can go down to 1.2 crores. Correct? Option payoff is 1 or it is 1.3 crores. Correct? Uh, yes. So this is 1 crore or 1.3 crore. So therefore, we again do we again use the same formula, that is 2.5 is equal to 3.5 into probability plus 1.2 into 1 minus probability. So you get probability of 0.652, which is your 65.2%. Again, you put this into option. So you either get a payoff of 1, that is this, or you get a payoff of negative 1.3, that is this. You multiply it by probabilities divided by your risk-free rate of interest, you will get 0.1848 as your value of option. So one point you have to remember in this question is VAT is used to discount the project cash flows and risk-free rate is used to discount the options cash flow. Okay, so if you want to discount your project, you use weighted average cost of capital. If you want to discount your option value, you use risk-free rate. So since the NPV of payoff is currently, since the NPV is currently A, it is advisable to wait and see, as NPV may turn out to be positive after 1 year. So currently your NPV is negative. Therefore, it makes sense that you wait for 1 year and then decide whether you want to install these or not. Clear? With this, we are done with this chapter, and I will see you in the next one.